$28 trillion in enterprise value is about to be unlocked, potentially swallowing nearly half of the entire global equity market as autonomous tech goes mainstream.
That is the staggering forecast from Cathie Wood of ARK Invest, and she is just the first expert we are covering in this high-stakes intelligence briefing.
We have leveraged AI to strip away the fluff from hours of research, delivering the core alpha from analysts like Nick Gerli, Snider, and deWolf in just a fraction of the time.
You will learn why the housing shortage is officially over, and how a specific unemployment trigger just signaled a point of no return for the economy.
But before we dive into the data, do you know why deWolf is calling this current market rally vicious and potentially a total trap for retail investors? We are looking at ARK Invest's big ideas for 2026, and Cathie Wood is dropping a bombshell. Autonomous vehicles could create $28 trillion in enterprise value.
It is staggering. Cathie argues that robotaxis will completely redefine global transportation, and that 28 trillion figure is almost half the value of the current global equity market.
Wait, 28 trillion? With a T? Are we talking about real cars or sci-fi movies here?
It is very real. Cathie believes the shift is happening much faster than the market realizes, but there is a massive catch involving regulatory hurdles we will get to in a moment.
The core of Cathie Wood's thesis is price. She predicts robotaxi rides will cost just 25 cents per mile.
Hold on, 25 cents? That is cheaper than taking the bus or even owning a used clunker.
Exactly, and that is why ARK is so bullish. But if the tech fails just once, that 28 trillion could evaporate overnight.
Which is why Cathie's data on safety is the most critical part of this entire report.
Cathie Wood's team suggests that the cost of point-to-point travel is about to fall off a cliff.
Right. Current ride-hailing is around $2 a mile, but ARK sees that dropping to 25 cents thanks to autonomous tech.
So you are saying I could stop paying for insurance, gas, and parking for less than the price of a gumball?
That is the goal. Cathie believes this price point makes private car ownership obsolete for most of the world.
It is a massive disruption to the entire automotive industry as we know it. One of the biggest pushbacks is safety, but Cathie Wood points to data showing autonomous systems are 80% safer than humans.
The numbers are hard to ignore. Humans get distracted, tired, or angry. Robots just drive.
80%? I mean, I have seen some bad drivers, but is the software really that much better already?
According to ARK's analysis of accident rates per million miles, yes, it is significantly more reliable than a human behind the wheel.
And that safety record is what will eventually force regulators to give the green light.
Cathie often cites Wright's law, which states that for every doubling of cumulative production, costs drop by a fixed percentage, specifically 28% for batteries.
That is the engine behind the price collapse. More cars mean cheaper batteries, which means cheaper rides.
Wait, so the more of these things we build, the cheaper they get. It is like the opposite of everything else right now.
Precisely. It is a deflationary force that Cathie believes will drive mass adoption by 2026.
So my future commute is basically being funded by mass production. I can get behind that.
Cathie Wood also argues this is a winner-takes-most market because of data advantages.
The company with the most miles driven has the most data, which creates the safest software. It is a virtuous cycle.
So we are basically looking at a future where one or two companies own the entire transportation grid.
That is the implication. Whether it is Tesla or Waymo, the leader gets a massive head start that is almost impossible to catch.
It is the ultimate moat. Data is the new oil in the world of autonomous transit. ARK predicts that by 2030, robotaxis could account for 50% of all urban miles driven.
That is a massive shift in just a few years. It implies a total collapse in traditional car sales.
50%? That sounds like a lot of empty cars rolling around our streets.
They won't be empty. They will be constantly moving people around, maximizing efficiency in a way we have never seen.
If Cathie is right, the parking lot, as we know it, might disappear.
In the shorter term, Cathie Wood expects the enterprise value of these platforms to hit $10 trillion within 5 years.
That is why she is so heavily invested in the space. The upside is virtually unprecedented.
So, if I'm looking at my portfolio, I should be looking at who has the best self-driving tech right now.
Exactly. ARK's research suggests the market is currently mispricing this entire sector.
$10 trillion. I guess I need to start reading those tech specs a bit closer.
Cathie Wood suggests the most important metric to watch is miles driven by these autonomous fleets.
Data is the lead indicator. More miles means the AI is learning faster and getting safer.
So if I see one company's mileage spiking, that is a signal that they are winning the race.
Precisely. It is the clearest way to see who is grabbing that winner-takes-most advantage. To keep an eye on city-level regulations. Cathie notes that as soon as one major city proves it works, the rest will follow like dominoes.
Once the safety data becomes undeniable, mayors won't be able to ignore the cost savings for their citizens.
So look for the first city to go fully autonomous, and then watch the stock tickers.
That is the play. It starts locally before it goes global.
Got it. I'm keeping my eyes on the road. Literally.
We're breaking down Matt deWolf's latest alert. These bear market rallies aren't your friends. They're actually designed to trap you before the next leg down.
Matt is seeing a classic dead cat bounce pattern across the S&P 500 and the Nasdaq right now.
Wait, a vicious rally? I thought rallies were supposed to be the good part, where my portfolio goes green.
That's the trap. Matt says the speed of these moves higher is actually a signal that the downward trend is still very much in control. The big reveal? Matt says if the S&P 500 ETF, the SPY, can't clear 400, we're headed for a fast drop.
Exactly. And while we're seeing some green today, Matt points to a massive risk in Apple that could tank the whole market, which we'll get into shortly.
400? That sounds like a big psychological number. Is that why everyone is freaking out?
It's where the sellers are hiding. Matt's data shows a massive wall of supply at that level.
Matt deWolf argues that what looks like buying is actually just short sellers covering their tracks.
Right? When shorts buy to close, it pushes prices up fast, but there's no real long-term conviction behind it.
So it's like a fake out. Like a runner sprinting for 10 feet and then just stopping.
Precisely. Matt's technicals show volume is actually thin during these spikes.
And Matt emphasizes that thin volume rallies are usually sold off twice as hard.
Great, so the bounce is just a setup for a bigger fall. Classic.
According to Matt, 390 on the SPY is the absolute line in the sand for bulls.
If we close below 390, Matt's model suggests a straight shot down to the 375 level.
Hold on, that's a $15 drop. For my small account, that's a lot of damage.
It's huge. Matt notes that the lack of support between those levels makes the drop potentially very violent. Matt deWolf is keeping a laser focus on Apple, specifically the $140 mark.
Apple accounts for such a huge weight in the indices that if it breaks 140, the whole market goes with it.
Wait, if Apple sneezes, the S&P catches a cold.
More like pneumonia. Matt's analysis shows Apple has been the only thing keeping the tech sector afloat.
So if you're long, you'd better pray that 140 level holds like a fortress.
I'm checking my iPhone right now. Please stay strong, buddy.
Over in Techland, Matt sees the QQQ struggling mightily with its 200-day moving average.
It's a classic rejection. The Qs tried to poke their head above water and got dunked immediately.
Moving average. Is that like the normal price for the last 200 days?
Basically. And when the price stays below that average, Matt says the bears are still the ones driving the bus.
And the bus is heading toward a cliff if the Nasdaq doesn't find buyers fast.
I think I'll just walk. Thanks.
Matt predicts a retest of the 370 level on the SPY before the end of the quarter.
His reasoning is based on the vicious rejection at 400. The momentum just isn't there for a breakout.
Wait, so we could drop almost 10% from here?
That's exactly what Matt's chart is screaming.
Unless we get a massive fundamental shift, the path of least resistance is down.
Okay, so buy the dip is officially cancelled?
Matt also expects the VIX, the market's fear gauge, to spike back above 30.
When the VIX is low, people get complacent. Matt says that's when the biggest drops happen.
Fear gauge. So when that goes up, everyone is panicking.
Precisely. It measures how much people are paying for insurance on their stocks.
And right now, that insurance is looking cheap, which is usually a sign of a looming storm.
I should probably buy an umbrella, or some puts.
Matt's biggest takeaway? Don't watch the opening, watch the close.
The institutions trade the close. If we close red, the rally is likely over.
So I shouldn't celebrate a green morning.
Not according to Matt. The afternoon fade is where the truth comes out. Finally, Matt reminds us that sitting in cash is a perfectly valid strategy right now.
It beats losing 10% in a week because you tried to catch a falling knife.
Wait, you mean I can just do nothing and be winning?
In this market, sometimes doing nothing is the smartest trade you can make.
Exactly. Let the vicious rallies burn out the emotional traders while you wait for real support.
I think I can handle doing nothing. I'm actually an expert at that.
Nick Gerli just dropped a bombshell. Zillow, the biggest name in real estate data, basically just canceled the housing moon mission.
It's a massive shift. Nick points out that Zillow slashed its home price growth forecast from nearly 2% down to a measly 0.9% for the coming year.
Wait, 0.9%? That's not even keeping up with inflation. So houses are basically losing value in real terms.
Exactly. And that's the alpha here. The inventory dam has finally broken, and the data is starting to reflect a much colder reality.
According to Nick Gerli, we are looking at inventory levels hitting 4-year highs in many regions, which is a complete reversal from the pandemic era.
It's wild, because for years the narrative was, there's no supply. Now the supply is flooding back.
Hold on. If there's more supply, shouldn't prices be dropping way faster than 0.9%?
Nick suggests we're in the frozen phase where sellers are still in denial, but the numbers don't lie. While the South is seeing a bloodbath, parts of the Northeast are still strangely resilient. We'll see why that's a trap in a minute.
Nick Gerli's core thesis is that the housing shortage is officially over, especially in the Sun Belt.
Right? In places like Florida, inventory is up 40% compared to last year. That is a massive spike in a very short window.
40%. Are people just fleeing Florida? Or is nobody buying because of the high rates?
It's both. High mortgage rates and skyrocketing insurance costs are scaring away buyers, while sellers are rushing to the exits.
So the shortage was really just a massive pileup of people waiting for lower rates that never came.
And now they're all trying to squeeze through the door at the same time. Messy.
Nick notes that price cuts are no longer the exception, they're becoming the rule.
Specifically, in several major metros, over 30% of active listings have had to slash their asking prices just to get a look.
30%. So if I'm looking at 10 houses, 3 of them are already on sale.
Basically, Nick explains that this is a leading indicator of where the actual sale prices are headed.
It's a classic buyer's market transition, but the buyers are still on strike.
I mean, with rates at 7%, who can blame them?
One interesting wrinkle Nick highlights is the Northeast. Unlike Florida or Texas, states like New York and Massachusetts aren't seeing that inventory surge yet.
Wait, so does that mean the Northeast is safe from a crash?
Nick wouldn't use the word safe. It just means they're lagging behind. The demand is still dropping there too. It just hasn't hit the panic sell phase.
Exactly. Low inventory is keeping prices propped up, but if the economy cools and unemployment ticks up, that dam will break just like it did in the South.
So it's not a different story, just a delayed chapter?
Spot on. The macro pressure is universal.
Nick also discusses the hidden threat, home builders. They are offering massive incentives that regular sellers can't match.
Builders are buying down mortgage rates to 5% or even 4%. If you're an individual seller, you're competing against a corporation that can basically bribe the buyer.
Hold on, 4% mortgage? How is a regular guy supposed to sell his house against that?
He can't. Not unless he drops his price by $50,000 or $100,000.
Nick Gerli points out that this is why new home sales are holding up, while existing home sales are falling off a cliff.
So the used house market is essentially stuck in the mud.
What's the end game here? Nick is looking at a significant correction through 2025.
He's forecasting that, while Zillow says 0.9% growth, the real-world decline could be 5 to 10% when you adjust for inflation.
Wait, so my house could lose 10% of its value in a year? That's tens of thousands of dollars.
For many, yes. Nick's analysis shows that as inventory continues to outpace demand, sellers will lose their pricing power entirely.
And remember, this is coming off the biggest price bubble in history.
What goes up must come down. I just didn't think it would be my kitchen's value.
Nick also predicts a chill in the rental market. Many would-be sellers are turning into accidental landlords because they can't sell.
Wait, if they can't sell, they just rent it out. Doesn't that just flood the rental market too?
Bingo. Nick argues that this shadow inventory will drive down rents, making it even harder for investors to cover their mortgages.
Which eventually leads to forced sales. It's a feedback loop that Nick thinks will dominate the next 18 months.
So, the passive income dream is turning into a sell-it-fast nightmare.
So what should we actually do with Nick Gerli's data?
He recommends ignoring the national headlines and tracking months of supply in your specific zip code.
Months of supply. That's just how long it takes to sell everything on the market, right?
Exactly. If it's over 6 months, you're in a buyer's market. If it's climbing, don't buy yet. Prices are likely headed lower.
Patience is the name of the game. Don't let a slightly lower rate trick you into a falling asset.
Got it. Watch the inventory, not the hype. I'm keeping my down payment in the bank for now.
Jeff Snider's latest analysis is a gut punch. He says we've officially passed the point of no return because unemployment hit 4.3%.
That's the alpha right there. According to Jeff, historically, once the jobless rate climbs 0.5% from its low, it never stops until a recession is over.
Wait, 4.3%? That sounds low. My gym is still packed. Is it really that bad?
It's about the momentum, not the level. Jeff argues that the engine of the economy has already stalled, and we're just gliding toward the crash now.
We're reviewing the data from Eurodollar University, where Jeff Snider tracks the hidden pipes of the global financial system.
He's seeing signals in the bond market that suggest a massive dollar shortage is finally coming to a head.
Dollar shortage. I have dollars in my wallet. Where are they disappearing to?
It's not your wallet, it's the banks. They're stopping the flow of credit, and Jeff says that's the real no-return moment. Jeff Snider's thesis is simple. The labor market doesn't just cool, it cracks, and that crack is visible now.
He notes that when job openings drop and unemployment rises even slightly, businesses shift from hiring to surviving.
Hold on. So, cooling is just a polite way for economists to say people are getting fired?
Basically. And Jeff thinks we'll see that accelerate as companies realize consumers are tapped out. Jeff references the SOM rule, which was just triggered. It's got a 100% track record for spotting recessions.
Exactly. Once that 3-month average of unemployment rises 0.5%, the game is over. Jeff says the data is undeniable.
A 100% track record. That's better than my weather app. Why isn't everyone panicking?
Because they're looking at the past. Jeff is looking at the plumbing. The pipes are dry. Now, let's talk about the bond market. Jeff highlights that the yield curve is finally uninverting. Sounds good, right?
Actually, it's terrifying. Jeff explains that the curve uninverts because the market expects massive emergency rate cuts.
Wait, so the curve going back to normal is actually the alarm bell? That is so counterintuitive.
It's a bull steepener. It means the short-term rates are crashing because the Fed is about to panic.
Jeff's core expertise is the Eurodollar system, basically offshore dollars that run global trade.
He's seeing those banks tighten up. If they don't lend, the whole global engine seizes up. It's a liquidity desert out there.
So if global banks stop playing nice, does that mean my local bank might get stingy with car loans?
It's already happening. Look at the loan officer surveys. They're slamming the doors shut.
Jeff predicts the Federal Reserve will start cutting rates soon, but it won't matter.
He thinks they're behind the curve. By the time they cut by 50 or even 100 basis points, the job losses will be baked in.
So the Fed is like a guy bringing a squirt gun to a forest fire.
Exactly. They're reacting to last month's news while the future is already burning. Jeff expects a hard landing. No soft landing. No landing. Just a straight drop in GDP.
He points to the income gap. People are using credit cards to survive and they're hitting the limit.
I definitely felt that at the grocery store. My credit card is sweating.
When that spending stops, the GDP numbers turn red. Jeff sees that happening by the fourth quarter.
What's the takeaway? Jeff says, watch the 2-year and 10-year treasury spreads.
When the 2-year yield drops below the 10-year, that's your final get-out signal for risky assets.
Check the spreads. Got it. Is that before or after I hide my cash under the mattress?
Maybe just stick to safe haven bonds for now. Capital preservation is the name of the game.
Jeff also suggests prioritizing liquidity. Don't get stuck in investments you can't sell in a hurry.
Right. High-quality debt and cash equivalents. Avoid the junk when the tide goes out.
So no get-rich-quick crypto schemes this month.
Probably a good idea. Jeff's data says the storm is already here. Today, we are analyzing a massive warning from Ian Harris, a veteran market strategist who says the recent surge in gold is a major red flag for stocks.
Ian shared with David Lynn that we are seeing a historic shift in how metals are trading relative to the broader market.
Wait, so when gold goes up, it's actually a bad thing for my stocks?
Exactly. Ian calls it the canary in the coal mine for an impending crash.
In his discussion with David Lynn, Ian explains that metals often sniff out trouble months before the headlines catch up.
So he's basically saying the metals are the market's crystal ball.
Pretty much. And right now, that crystal ball is looking pretty dark for equity investors.
Let's break down why Ian thinks a 20% correction could be right around the corner.
Ian Harris's core thesis is simple but terrifying. The gold breakout is a signal that stocks are about to drop by at least 20%.
He notes that gold and silver are currently decoupled from interest rates, which only happens during major regime shifts.
Hold on, 20%? That's not a dip. That's a full-on collapse of my portfolio.
Ian's analysis suggests that when metals lead, equities eventually follow to the downside.
While stocks look safe now, Ian warns that the underlying data for silver shows a massive risk for the S&P 500.
So the shiny stuff is telling us the tech stocks are overpriced?
Ian Harris points to a massive catalyst. Central banks have bought over 1,037 tons of gold recently.
That is the highest level of buying in decades. They are ditching dollars and hoarding the yellow metal.
Wait, 1,000 tons. If the big banks are scared, shouldn't we be too?
That's Ian's point. They are hedging against currency collapse and geopolitical instability.
So while they tell us everything is fine, they're filling their vaults with gold.
Classic do as I say, not as I do situation.
Ian highlights that silver is currently 25% undervalued compared to where gold is trading.
He thinks silver is about to play catch-up in a big way.
Undervalued by 25%. Is this a buy signal for silver then?
Ian's data shows that when that gap closes, it usually results in a violent move for industrial metals.
And that violent move usually breaks the stock market's momentum.
So silver is the cheaper, angrier cousin of gold right now.
Ian Harris calculates that at least 15% of current metal prices is just a pure fear premium from global conflicts.
According to Ian, this premium isn't going away as long as supply chains remain threatened.
15% just for being scared. That seems like a high price for anxiety.
In a crisis, people pay whatever it takes for safety. Ian sees this as a permanent floor for gold prices.
And as that floor rises, the ceiling for stocks starts to lower.
So we're trapped in a room with a rising floor and a falling ceiling. Terrific.
Ian Harris's most dire prediction? A 3,000-point drop for the S&P 500 if credit markets freeze.
He believes the current debt levels are unsustainable once the metal markets peak.
3,000 points. That would take us back years. Is he for real?
Ian's analysis is based on historical cycles. When metals move this fast, the everything bubble usually pops.
It sounds like he's preparing for a total reset, not just a correction.
I'm gonna need a lot more coffee to get through this forecast.
On the flip side, Ian predicts gold will hit $3,000 per ounce by the end of the year.
This would be driven by a flight to quality as the equity crash begins.
3,000. It's never been that high. Does that mean I should buy gold now?
Ian suggests it's more about protection than profit at this stage.
If he's right, gold is the only life jacket in this ocean.
I'm not a good swimmer, so I'll take the life jacket.
Ian Harris recommends watching the US dollar index. If the dollar and gold rise together, it's a sign of ultimate distress.
Typically, they move in opposite directions. Ian says that joint rally is the final signal to exit stocks.
So if the dollar goes up and gold goes up, I should run for the hills.
Basically, yes, it means nobody trusts anything except cash and gold.
Finally, Ian says to monitor the silver to gold ratio. If silver starts outperforming gold, the end of the stock rally is near.
It's the final melt-up phase of the commodity cycle.
Alright, so I'm watching the dollar, watching silver, and keeping an eye on my exit strategy. Got it.
That is the Ian Harris playbook for surviving the next few months.
Survival sounds good. I'll stick with that.
Lance Roberts is suggesting that despite all the doom and gloom, the stock market might be on the verge of screaming higher on any shred of good news.
Exactly. Lance's discussion with Adam Taggart centers on the idea of climbing a wall of worry, where extreme negative sentiment actually fuels a rally.
Wait, screaming higher? I thought everyone was worried about a recession and high interest rates.
That's exactly the point. When everyone is already hiding under their desks, there's nobody left to sell, which creates a coiled spring for a bounce. Lance Roberts argues that the massive gap between bearish sentiment and actual market performance is the single biggest story right now.
Right? Lance points out that even though retail investors say they're terrified, they haven't fully exited, but institutional positioning is very defensive.
Wait, so if the big money is already out, any good news forces them to buy back in so they don't miss the boat?
Precisely. It's the FOMO factor. If the S&P 500 starts ticking up, those managers have to chase it to keep their jobs.
So the pain trade isn't a crash. It's actually the market going up while everyone is sitting in cash.
That's a wild way to look at it. Being right about the economy, but losing money because the market ignores it.
Lance mentions that professional fund managers are holding some of the highest cash levels we've seen in years.
True. And he notes that when institutional allocation to stocks is this low, the market often finds a bottom because the selling pressure is exhausted.
So, if they have all this cash sitting there, what happens if a good inflation report comes out?
They deploy it fast. We're talking billions of dollars flooding back into the S&P 500 in a matter of days.
And that's how you get those face-ripping rallies that leave the bears behind.
Face ripping? Sounds painful for the people who stayed in cash.
Another key part of the Lance Roberts thesis is that Wall Street has lowered the bar for earnings so far that almost anything looks like a win.
So it's like a student who was expected to fail suddenly, getting a C-, and everyone celebrates?
Exactly. If earnings are just less bad than the nightmare scenarios, stocks tend to rally.
Lance highlights that this low bar is exactly what allows the market to ignore bad economic data as long as corporate profits aren't collapsing.
Okay, so the economy can be messy, but as long as companies aren't dying, the stock market stays happy?
For now, yes. It's all about the delta between expectations and reality. Technically speaking, Lance Roberts is watching the 200-day moving average very closely for the S&P 500.
He notes that as long as the market stays above that level, the long-term bullish trend is technically still in play, despite the headlines.
Hold on, what's a moving average? Is that like the average price of the last 200 days?
Spot on. It acts like a floor. If we stay above it, investors feel safe. If we break below it, that's when the real panic starts.
And right now, the market is bouncing off that floor every time it gets close.
So the floor is holding, even with all the weight of the bad news on it.
Lance predicts that we could see a year-end rally of 5 to 10% if we get a few positive inflation prints.
He thinks the seasonal Santa Claus rally could be supercharged this year because of how many people are positioned for a crash.
Wait, 10% in 2 months? My savings account takes 3 years to do that.
Welcome to the stock market. When a short squeeze happens, moves that should take months happen in days.
But Lance does warn that this would be a tactical rally, not necessarily a new long-term bull market.
So, enjoy the ride, but keep your hand on the exit handle.
Lance Roberts warns that the number of people betting against the market is at a level that usually precedes a massive squeeze.
Right? If the S&P 500 breaks through key resistance, all those short sellers have to buy back their shares to stop the bleeding.
So they're panicked to get out, actually pushes the price up even more for everyone else.
Exactly. It becomes a feedback loop. Higher prices force more buying, which leads to even higher prices.
It's the ultimate "I told you so" for the remaining bulls.
I hope I'm on the right side of that loop.
Lance suggests watching sentiment gauges like the Fear and Greed Index. When it hits extreme fear, that's often your buy signal.
And when it hits extreme greed, that's when Lance says you should start taking some profits and moving to the sidelines.
So I should basically do the opposite of how I feel. If I'm scared, buy, and if I'm happy, sell.
Pretty much. Investing is the only business where customers run out of the store when there's a sale.
Lance Roberts is big on risk management. He emphasizes using stop losses to protect your capital if his thesis is wrong.
A stop loss? Is that like an automatic sell button if the stock drops too much?
Exactly. It's your insurance policy. Lance says you should never let a small loss turn into a portfolio-killing disaster.
According to Lance and Adam's talk, the goal isn't to be a hero, it's to stay in the game long enough for the big moves to happen.
Got it. Protect the money first, make the gains second.
Let's kick things off with Cathie Wood. Her main thesis: autonomous vehicles will redefine our transportation framework.
Yes, she argues that this shift won't just impact cars, but the entire market structure as we know it.
So, it's more than just fancy cars. It's about changing our whole way of life.
Exactly. That's why this disruption is estimated to unlock $28 trillion in value. Now, moving on to Nick Gerli. He claims the housing shortage narrative is over.
Right. He believes we're heading towards a more normalized market where buyers can actually afford homes.
So, after years of despair for buyers, there's finally a light at the end of the tunnel.
Yes, and it comes from broader economic conditions, unlocking potential for sustainable growth. And lastly, Jeff Snider warns of a stock crash. His thesis hinges on critical issues in the labor market and monetary policy.
Correct. He argues that current monetary policies are masking deeper economic weaknesses.
So, he's basically saying, we're riding a wave that could crash at any moment.
Absolutely. His perspective adds urgency to reassess our financial strategies. Interestingly, despite their differing views, all three guests highlight the need for vigilance in today's market.
Exactly. Cathie sees volatility in consumer adoption of new tech, Nick points to fluctuating home values, and Jeff sees upcoming risks in the stock market.
So they all agree. We're kind of walking on eggshells here.
Yes, and with each having distinct factors to watch. Cathie and Nick share common ground on the idea that technology and housing will reshape their respective sectors.
They do. Cathie believes in tech-driven disruption, while Nick argues that housing will realign once supply catches up.
So they're both optimistic about tech, just for different reasons.
Precisely. They're optimistic about the potential for growth, albeit in different arenas. Now on to the disagreements. Cathie says private car ownership is ending, while Jeff thinks that's overly optimistic.
Jeff argues that consumer habits die hard. People love their cars too much to give them up quickly.
Wait, so Cathie thinks we're all jumping in Robotaxis tomorrow, and Jeff's saying, not so fast?
Exactly. It highlights a fundamental clash in their views on consumer behavior. And then we have Nick and Jeff at odds over real estate dynamics.
Right. Nick says we're transitioning to a more balanced market, but Jeff warns that inflation could send prices higher again.
So, Nick's seeing a peaceful transition, while Jeff foresees a battle ahead.
That's a perfect way to summarize their contrasting outlooks. If you enjoyed this analysis and want to keep up with expert insights, please hit that like button and subscribe.
We bring you condensed, must-know market trends and predictions. No fluff.
Definitely. This breakdown saved me hours of research.
Catch you next time for more actionable financial tips and analysis. Don't miss it.